Welcome to Talk Tickers. We dive deep into earnings calls.
Yep, pulling out the key insights for investors.
And today, it's Macerich. We're going to dissect their latest call.
Right. The mission, as always, is to filter out the noise, figure out what's really moving the needle.
So, overall impression from the call? Seems like they felt pretty good about things.
Yeah, definitely a positive sentiment coming through. They seem pleased with their progress,
Okay, let's get right to some numbers then. FFO funds from operations, always key in REITs.
Exactly. Excluding specific items, it was about $87 million, or 33 cents a share.
And how does that compare?
Up nominally from $75 million last year, though still 33 cents per share. They pointed to higher leasing revenues driving that dollar increase.
Gotcha. And what about property performance, same center NOI?
Right, net operating income. Excluding lease termination income, it saw a modest bump. 0.9%.
Just under 1%, okay.
But here's the interesting bit. They have these Eddy properties they exclude sometimes, take those out. And the growth jumps to 2.4%. Gives a better view of the core portfolio, really.
Right, strips out maybe assets being redeveloped or sold or something. Makes sense. Now, something that really jumped out at me was leasing.
Oh, yeah. Huge momentum there. They signed 2.6 million square feet of leases.
2.6 million. That sounds like a lot for Q1.
It is more than double the same quarter last year.
Wow. Mostly renewals, though.
A big chunk, yeah. 2.3 million square feet were renewals. But still, that volume...
It definitely signals demand. What about new deals?
Making good progress there, too. They said they're at 60% completion against their new lease targets.
And what were those targets again?
The goal was 50% by mid-2025, and they're hoping for 70% by year-end. So they're running ahead.
Ahead of schedule.
Yeah.
Okay. And they mentioned this snow pipeline, signed but not open.
Right, SNOW. That's grown to $80 million now.
$80 million.
And they're projecting it hits $100 million by the end of this year. So that's future revenue, basically locked in.
Provides some nice visibility. Okay, let's unpack this leasing progress a bit more. They sounded really optimistic.
They did. Being ahead on these targets gives them confidence, about hitting those 2028 leverage and earnings goals they've set out.
And they're focusing more on new deals now?
Yeah, that seems to be a key focus.
Yeah.
The idea is that new deals bring higher spreads, more incremental NOI compared to just renewing.
Makes sense. Do we have numbers on those spreads?
We do. Trailing 12-month spreads overall were pretty healthy, 10.9%.
Okay.
But look at the split, 22% on new deals versus 7% on renewals. And if you look at just same space deals, it's even starker. New deals were up 37.4%.
37%.
And renewal.
Just 1.3% on a same space basis really highlights the power of re-tenanting vacant space right now.
Yeah, that's a huge difference. Shows the demand for good locations. And this is a trend, right?
14 consecutive quarters of positive leasing spreads. So yeah, definitely a consistent trend.
And who are they signing? Any big names? Oh, yeah, they mentioned some really strong brands. Zara, Uniclo, getting new flagships at Tyson's Corner Center.
Big international retailers.
Exactly. Also names like Aloyoga, Abercrombie Fitch, Aritzia, Rag & Bone, even Loro Piana in some prime spots.
So top-tier tenants wanting space in their centers.
It really speaks to the quality of their locations. And they also mentioned their executive leasing committee is much busier than last year.
Suggests the pipeline is still strong.
Seems like it. They also sound like they've pretty much handled their 2025 expirations and are already working deep into 2026 leases.
Proactive. What about Forever 21? That bankruptcy must have left some holes.
You'd think so, but they're actually framing it as an opportunity.
How so?
To re-merchandise those spaces and get significantly higher rent. They said over half the square footage already has commitments.
Already?
Yeah, and at rents exceeding what Forever 21 was paying.
Turning a negative into a positive then. And back to that snow pipeline, the $80 million. When does that revenue actually hit the books?
Good question. It's incremental over 2024 levels. They expect about $25 million of it to come online in 2025.
Okay.
$6 million already landed in Q1, apparently. The rest is expected between 2026 and early 2028.
So a multi-year benefit stream there. Okay, that covers leasing pretty well. Let's shift to the overall portfolio performance. How are sales and traffic holding up?
So portfolio sales per square foot came in at $837.
How does that compare?
Basically flat compared to Q4 2024.
Okay.
But again, pull out those Eddy properties.
Uh-huh.
And it's $928 per square foot, which is actually up $13 from Q4.
Right. So the core portfolio is still inching up.
Yeah.
And foot traffic. People still coming to the malls.
Seems so. Traffic was up 2% year over year.
That's positive. Occupancy, though, I thought I saw a dip.
You did. It was 92.6%, down from 94.1%.
Why the drop?
They said it was mainly temporary holiday stores closing out, plus the transition happening at Fashion District Philadelphia.
Oh, okay. So some temporary factors.
Exactly. Exclude the Eddy properties again, and occupancy was 95.2%. Still pretty strong.
Okay, that makes sense. Let's turn to the balance sheet and financials. Any key moves there?
Yeah, a significant one. They closed a new $340 million mortgage on Washington Square, 10-year loan.
Oh, what kind of rate did they get?
Pretty good, actually, 5.58%.
In this environment, that doesn't sound too bad for a 10-year deal. What did they do with the cash?
Used it strategically, paid off debt on Flatiron Crossing, probably had worse terms, and paid down their line of credit.
Smart move.
Yeah.
Improving the debt profile. How's their overall leverage looking? Net debt to EBITDA.
It's down to 7.9 times now.
Still a bit high, but moving down.
Yeah, and their target is to get that into the low to mid 6 times range in the coming years. So clear focus on deleveraging.
Are asset sales part of that plan?
Definitely. Big part. They've hit $1.1 billion in sales, either closed or under contract.
And the target was?
$2 billion. So they're more than halfway there. Recent closures were Wilton Mall and South Park. Lakewood is under contract now.
Okay, chipping away at that target. Any more planned?
They mentioned identifying another maybe $400 million worth of assets that could be sold or potentially given back to lenders.
Give back.
Okay.
So continued pruning of the portfolio.
Seems like it. And it's not just the big properties. They're selling out parcels and land, too.
Right, those smaller pieces.
Yeah, they've got $77 million sold or under contract there against a target for 2025 of $100 to $150 million.
What kind of pricing are they getting on those, like cap rates?
They mentioned restaurant out parcels trading in the mid 5% cap rate range.
Mid fives. Okay. So with all this leasing, financing, selling, what's the big picture strategy, the path forward?
Yeah, they seem really confident they're executing that plan. It's all about, simplifying the business, improving operations, and hitting that leverage target.
And they see a key point coming up.
A major inflection point, they called it. Around mid-2026. That's when they expect the plan to be mostly complete.
Mid-2026.
Mm-hmm.
Something to circle on the calendar. What kind of performance are they expecting from the remaining go-forward portfolio?
For that core group, they're talking same-store NOI growth of 3-4% in 2026.
Okay, solid.
And then significantly higher growth in 27 and 28.
And occupancy targets for that core?
Aiming for around 89% physical permanent occupancy, plus keeping those 26 key anchor locations filled.
Interesting. Did they mention tariffs? Any impact there?
They said minimal impact so far. Retailers seem to be mostly moving ahead with their leasing plans regardless.
Good to hear. Any big redevelopment projects underway?
Yes, Green Acres Mall on Long Island. They're about to break ground on a redevelopment there.
Is there much interest? Pre-leasing?
Sounds like it's strong. Almost 50% committed already and another 17% under letter of intent.
Wow. Well ahead of construction. When's that due to finish?
Expected completion is fall 2027.
Okay. So pulling this all together for someone listening, maybe an investor, what are the key takeaways here?
Well, first, that leasing progress is real and ahead of schedule. The strong demand from good retailers, that says something about the health of well-located centers.
Right, physical retail isn't dead, at least not for these kinds of properties.
Exactly. And the focus on new leases with those higher spreads, that suggests better revenue quality and growth potential, not just hanging on to existing tenants. Plus, the asset sales and refinancing are definitely shoring up the balance sheet, reducing risk.
And that mid-2026 inflection point you mentioned.
Yeah, that's a key milestone to watch. Could unlock significant cash flow and earnings improvement if they hit their marks.
And the SNOW pipeline gives some concrete visibility into future revenue.
Precisely. It's tangible, not just projections.
All right. Now for the part where we get a bit creative, our not financial advice segment. Time for some outrageous but plausible trade ideas based on this call.
Okay, let's brainstorm. How about this? Go long Macerich stock, but short a basket of, say, pure play e-commerce retailers.
Ooh, interesting. The rationale being?
Well, all this strong leasing, the focus on experience in prime locations, it suggests Macerich's type of brick and mortar has a resilient future. Maybe more so than online-only players facing high customer acquisition costs, right?
So betting on quality physical retail against challenged e-commerce. I like it. Plausible, definitely outrageous.
Exactly. What have you got?
Okay, here's one. Buy Macerich bonds maturing around 2028.
Okay.
But hedge it. Short, a broad REIT ETF.
Ah, isolating the company execution.
Exactly. If Macerich pulls off this deleveraging, hits those NOI targets by 2028, their bonds should appreciate as credit quality improves. The ETF short protects you if the whole sector tanks for unrelated reasons.
So you're betting specifically on Macerich's turnaround plan succeeding by 28, regardless of the broader REIT market.
Precisely. Outrageous? Maybe.
Right.
Plausible. If they execute, yes.
Both definitely make you think, based directly on what we heard in the call.
So wrapping up on Macerich's Q1 call. The big story seems to be execution, especially on leasing, running ahead of their own plan.
Yeah, strong leasing, clear progress on deleveraging, and that path towards a potential inflection point in mid-2026.
The focus on high-quality tenants and strategic redevelopments like Green Acres certainly positions them for potential growth ahead.
Absolutely. But as always,
This is just our take on the call, not investment advice. Do your own homework before making any decisions.
definitely. And we'd love to hear what you think. What are the biggest risks or opportunities you see for Macerich? Find us online, join the conversation.